big name for the topic, rewiring the global financial system. But it's really, at its core, it's what we're all here to do. And so let's get this going real quick. Super brief introduction by myself. I'm Steve Leahy. I am VP for a company called Kiln. We are one of the enterprise staking service providers. I spent the previous 3.5 years over at Circle, heading up strategy and relationships for the capital markets group there. And with that, what I would really like to do is ask each of you to give just a brief bio of yourself. You've already been on stage once, but maybe a short recap.
Yes, hello. I'm Katelyn. I'm the Chief Information Security Officer for Robinhood.
I'm Anna De Souza. I'm CEO of Agio Ratings. We are a VC-backed rating agency focused on high-growth emerging industries. Right now, 100% focused on rating default risk. We're rating risk in 45 exchanges, soon to expand to custodians, banks, brokers. Prior to that, I was a crypto risk lead at the Federal Reserve, so be kind. And prior to the Federal Reserve, I was employee number 3 and head of ops of FalconX, which is now a major crypto brokerage.
Awesome. Hi, guys. My name is Jesse, longtime Bitcoiner, crypto nerd. 2017 through about 2019, started in the mining space. That's where I kind of built my chops. Moved over to Binance, ran the pool for them. Then got really interested in DeFi. Left to a place called Rain, which is kind of like the Coinbase of the Middle East. And then now I am CEO of Trustware. We're a cross-chain peer-to-peer payments platform. Send anything to a single username and manage it all in the back end with your own self-custody. So really happy to be here.
Awesome. Here we go. So we do have a pretty broad panel. I love the fact that Anna has spent time as part of a regulatory supervisory position, which she's had. So I'm just going to outline real quick what we're going to talk about here. We've got 27 minutes and 13 seconds left. First up, we are going to talk about disrupting centuries-old financial models. We've all talked about in our prep call that there's a lot of things we're doing on-chain that actually is really just kind of like the back end there, but there's actually opportunity to completely disrupt the financial models, meaning revenue streams, types of interaction with customers that financial service players have been doing. The next topic we're going to cover is going to be the future of lending, DeFi lending, and yield farming. And at the end, we're going to take a couple of minutes talking about balancing innovation and regulation. And then we'll have a quick wrap up there. So with that being said, I'm actually going to ask to hand off to my left. Katelyn, we had talked about in the prep call that you were going to give kind of a brief history of TradFi and FinTech and some of the issues that remain unsolved. Can you walk us through it for just a moment or so?
I will do my best. Yeah, so I think the relationship goes back to when technology was first introduced to even financial services. And I think from 08 and 09, you saw the relationship that technology played between the interconnectivity of the mortgage crisis. And then I think going into now, we see a lot of the same things, but what we're trying to solve differently is the intermediary relationship that occurs, and that kind of that single point of failure or that centralized entity that can cause, kind of like havoc or mass destruction if one thing goes wrong. And then how because of technology, actually, more of those intermediaries are more interconnected than we even think to begin with. Yeah. And then that's why you tend to see some of the crises that you've seen either 08 or 09, even in crypto, what we saw like 2 summers ago. Everything is just like interconnected and related. And I think that's kind of where we start, and then moving into DeFi is what we're trying to solve with.
Yep, and she mentioned centralization, which is one of the terms you use. So before we even go any further, I'm going to go from the far side towards me. Jesse, 2 to 3 sentences. What's DeFi?
DeFi to me is ownership. It is also kind of what I'm wearing right now, which is privacy, and it's inclusion. It's the idea that it doesn't matter where you are, who your mom and dad were, what you studied, whatever it is. This is an open, permissionless system that affords a lot of the same kind of money Legos that I think traditional finance is gated from a lot of people, and it's a place to experiment. So yeah.
Anna, what's DeFi?
I think it's a range of financial services that are accessible to anyone, but via permissionless and transparent intermediaries, and I can't emphasize that word enough. A lot of people are like, there are no intermediaries in DeFi. There are, you need to think of them like that. But you also probably need a regulatory system that accounts for the differences between DeFi and non-DeFi intermediaries.
I agree with that. We're going to dig into it. What's DeFi to you?
I guess, democratization of financial assets in a more advanced technological way.
I think that makes sense. Okay, so noting that we've now got some different but primarily similar definitions of what DeFi actually is, and noting that seemingly like not the villain, but maybe we'll call it the foil of this story is going to be the centralization in the last 50 plus years of moving towards centralized systems. I was going to share briefly, I started at State Street Bank long enough ago that we were getting Excel files downloaded from sub-custodians around the globe and literally running functions to try to match trades, looking for out trades, and try to settle these mistakes that were made, which sounds like crazy to be doing now, but it really wasn't that long ago that we were doing this. So with that being said, thinking about permissionless DeFi, and I'm actually going to start off with Jesse here. What is the opportunity, what's the easiest opportunity for DeFi? Noting that your role with Trustware, what's the opportunity for DeFi to solve? Where can you make the most impact the fastest?
I think it's payments right now, but I think that the ball moves according to total value locked. Right now, I'm focused on payments because I think it's the product market fit killer use case. Just looking at kind of also bear market, bull market. I know a lot of us from the pre-call, we've been in this long enough to see multiple cycles. Doesn't really matter in terms of payments. Stable coins are on pace to out transact Visa, MasterCard, et cetera. So I look at that kind of as first and foremost.
And I'm going to jump to Katelyn for a moment, but I don't want to forget, Anna, please, with your background, jump in as you see fit. Katelyn is working for Robinhood, Chief Information Security Officer. And so you've got both a centralized financial services, you've got decentralized financial services, you've got wallets that you're creating, right? Where do you see the opportunity for your DeFi offerings to gain the most traction the fastest?
Probably, I think it's gonna have to be through our Web3 wallet offerings and being able to offer more connectivity, more protocol compatibility, probably a better wallet product to be able to use in conjunction with all of this. I think we'd probably have to gain traction better there.
And
more technology focused, honestly.
custodial wallets or non-custodial wallets, noting that you've spent time in a position of a regulator, where is the regulatory apparatus leaning? Is the regulatory apparatus saying to themselves, we'll figure out how to deal with non-custodial wallets? Or is the regulatory apparatus saying, oh crap, we have to find a way to nudge, cajole, choke point, whatever you want to do, people into using some form of custodial wallet, even if it's in this world of DeFi that's supposedly permissionless?
Look, I want to sit here and be an apologist for regulators because they can be quite myopic. Like a lot of them, you cannot be in that regulatory agency in any capacity and own any amount of crypto, for example. I think that makes it hard for regulators at all levels to really engage with some of the emerging technology, but I understand why that rule's in place. But at the same time, we have to remember that regulators are separate from legislators and they have to follow the laws, right, that are put in place, right, or the guidance that in the U.S. is issued through Congress. They have to interpret non-custodial wallets within the regulations that are in place today. And I get it that it's a very clumsy, kind of juxtaposition between, even the concept of wallets that are issued directly to consumers and then controlled by consumers is a little bit difficult. But I would say they're doing their very best to, at least from the efforts that I've seen, to try to figure out how to operate within existing regulations and allow for some degree of activity, even if it's experimental, innovative, not mass adoption scale kind of activity.
So is the end result in DeFi, and again, the seat I sat at Circle, I talked to a lot of the major financial institutions who are all building, but not everyone's gone live with stuff yet. The question often came down to, are we going to build in a permissioned network, or are we going to build on a truly open network, which therefore necessitates some form of valid identification standards that are accepted across the board. Any thoughts, any comments from this panel here as to, do we end up having permissioned networks? Do we end up having much better digital validation of KYC and AML sanctions? Is there going to be both?
I can go, and you guys can jump in wherever, but I think we're starting to see some of that with travel rule and how that's taken place in the U.S. and then what is required in Europe as well. It's starting, so it's gone from what it used to be, I don't know, like 5 or 6 years ago, where it's like you just need to know where you're sending it and you want your user to attest that they own it or something like, it was very like basic and rudimentary. Now it's like we want to verify that they actually own that wallet or can like sign something that says they own that wallet. So I think that's growing and expanding. You know, I don't know if it's Jesse, you might have thoughts on this too. I don't know if it's appropriate to tie identities to wallets in that way, but to just attest that you actually own it through like pub key derivation or something, I think could be appropriate. But yeah, I think we're starting to see some of that or going towards that direction now.
Yeah, I mean, I think that's a really good question. It's something we've thought about a lot. I look at this as like there's going to be kind of the more centralized side in terms of identification, and then there's probably going to be more ID standards on the decentralized side. We've looked at things like, for example, multi-sig, where you tie different pieces, or MPC, where you tie different pieces of real-world identification to keys, and for example, you need to reach a threshold signature to prove that you are that person. There's other ways of doing this, but I think that fundamentally we're going to go into a world where you can still maintain privacy and yet still have kind of omni-chain identification, and that will solve a lot of these issues. I do not think that we enter a world where it's as kind of private as it used to be, and you know, snooping software or whatever you call it is just too far along to really have that ever take place again. So that's my thoughts.
At some point, a regulator is going to say, we no longer need to instruct these financial institutions to send us this type of report in that format at this time of day. And will the regulators just say, you know what, I'll just pull it. It's out there, public information. Are the regulators just going to say, fine, I'll get it myself?
I mean, I would say that regulators would love to be able to get it themselves in real time. I think one of the challenges that the industry is having is that the regulatory apparatus, not only in the U.S. but broadly, spent decades, you know, kind of figuring out how KYC was going to work, right, for the purposes of preventing money laundering, financing of illicit activities. And the system is far from perfect, right? There are a lot of leaks, but it does give them information. And what we're offering them is a system that does not give them information as well or better, right? And expecting them to embrace it. And I think that that's going to be a challenge, right? If there is a way that we can coalesce around a vision of like, okay, here, we want you to be able to, you know, investigate and prosecute criminal activity. We're going to give you some of the tools to do that in a way that's privacy preserving. That would be the holy grail. I don't know how far we are from that vision.
You make a good point, because I know for me personally, I've been in the camp like, why can't the regulators just take it? But to your point, if you're not giving them something better, or at least equal to what they're used to, they have no incentive to really take it themselves, right? Okay. Hey, I'm going to change up focus a little bit here while sticking still to the idea of the business models in financial services. One thing that we talked about in the prep call is the ability with digital assets to do these atomic swaps between almost like a hot wallet and a yield function, a staking function, whatever that may be. It's one of the reasons I've made a move recently from my former employer to my new employer. Let's talk about what changes that can enable for consumers when you have this ability, rather than to move my money from my checking account to my savings account where I have to lock up for a CD for 6 months to get any money, or where if it takes a day and a half to move even from a savings account to a checking account. What's the change that consumers can expect when you're able to instantly swap assets in hyper real time?
I can take this, and I'm going to preface it with a little monologue. I'm from Brazil. I still have a lot of family there. I've spent a lot of time in the U.S., and a couple of years ago, I moved to Canada, and now I'm like really violating all of the, you know, prescriptive suggestions that Katelyn gave. And my company is actually headquartered in the UK. I spend a lot of time traveling and navigating across financial systems that are, very much rooted in their jurisdictions. The Canadian system, as it turned out, when I found out, the banking system is controlled by 6 banks, right? When I moved, I got unbanked from Venmo, not accessible. When I go to Brazil, they have an excellent PIC system, not accessible to me. I would love, as a consumer, to have some sort of supranational access, right, to payment rails. And that's really all I would like from DeFi. I do not think that democratizing complexity is a good goal.
I agree with that, honestly. Yeah.
It is. I mean, talking about moving from checking account, savings account, CD, that's seamless. Even RBC has managed to do that. And, they're great people, but I often tear my hair out with the experience at the Royal Bank of Canada. I think if we could just figure out how to make a very simple use case work for a lot of people, that would be great. But if we don't want to do that, recognize that this is a complex, possibly a luxury product, right? Move away from thinking that all of DeFi has to be D2C and start considering the possibility that it should just be B2B. However you define the Bs, DAOs, LLCs, whatever you want. Make complex products for experts, with specialized knowledge and the ability to grow that knowledge. Don't make complex products for people who, no matter how much information we give them, and Katelyn gives a lot of information, it's just going to be very, very hard for them to do it.
That goes back to what Katelyn was talking about earlier, right? That the goal is not to make something more complex for people.
Yeah, I think these are complex things to begin with, and I think the goal should not be to gamify it to make it look easy so that more people put money into it and they don't know what they're doing. I agree. We should solve simple use cases to start with and give people what they actually need or would want. I think to speak from an institutional standpoint also, to build what you described, I was running through it in my head. I'm like, if consumers were able to do this, I'm like, I would need to then build this, and this. And I'd probably need 4 new vendors and then something else. That's the other thing. A lot of crypto, your institutions are using 4, 5, and 6 vendors to offer you one product because it is so complex. There's no way one bank or one financial services company can actually build all of that and have enough people to run all of that. It would cost $1 billion. So that's the other thing to keep in mind is to make these types of more advanced product offerings for what is really a smaller group of people. It's a lot of money and a lot of time and energy, and I don't know that many people would actually be using it at this stage.
Yeah.
Valid point.
I think you're touching on something that we think about all the time, and I read a tweet recently, which is that there's 3 different types of crypto consumers. There's your crypto natives that want these ridiculous dashboards. They want to be able to do everything, right? Then you've got kind of retail users, which are more you kind of need to provide for them easier tools. And then you got people unbanked, right? That's a very big promise of DeFi, where you actually need to learn how to use the product by using the product. And so if you don't know who you're building for, you end up in a situation where you're in this kind of wishy-washy purgatory of, I have no idea who's actually going to use this. It's probably one of the hardest things about building here. But I do think that interoperability, as you guys describe it, is kind of the holy grail. And the reason for it is market. When I was at Binance, we did a lot of one-click solutions, and that brought in a lot of people where they're willing to give up a portion of the staking or the yield because they don't want to go through all of these different steps. And there are also companies that want to provide that to people that don't, like you're saying, don't want to go through all those steps. So there's a lot of room for APIs. There's a lot of room for kind of boutique solutions, and customers we've already seen are willing to pay for it. But fundamentally, the unification of chains, I believe, is because TVL is down across the board. That's total value locked, right? Same ball of money rotating around. We have yet to succeed, at least this cycle, in bringing more people in. Uniting the chains, I think, does that. That's my take.
So let me just, maybe a slight counterpoint, if I may, to toss it back to you guys. You were mentioning, Anna, how we don't necessarily need to create more complex solutions. We have a core set of users now for whom, as Katelyn mentioned, some are super sophisticated and we can make something more complex, some are less. That being said, no one thought we needed an iPhone until Steve Jobs put all that complex shit behind a simple interface. And so is that really the end goal where this goes, is that there will be a whole lot of complex stuff that's hidden behind some super app or some super hardware technology? Is that the end result?
I like your comparison. I think it's good, but I almost think it's apples to oranges in a way, because I do like it though. I did like it. Like, you put all the hard stuff behind a screen and made it touch, because he kind of did. But I also think it's apples to oranges, because you're talking about something it's much simpler. You're talking about an app versus an entire ecosystem of money and complex financial products and traditional assets. I told Anna this earlier. I was like, at one point I had to, because I know crypto better than I know TradFi, so I had to chat GPT the TradFi equivalent to a crypto product. It's like there's the inverse of that, and then there's people who don't know either. So I think I would probably disagree. Yeah.
No problem with disagreeing. All right, I'm going to switch up a little bit here, and we're going to switch a little bit to talking a little bit about the use of stablecoins in DeFi. And again, going back to our prep call, which was a fantastic call in meeting these guys and having this great conversation. A couple things that we brought up on this prep call was that is DeFi or on-chain risk management really any better than traditional risk management? Is that one of the benefits, or not necessarily? In DeFi, if you've got these intermediaries making credit, making decisions on lending, do we need the ratings agencies like Anna's running right now? And finally, I'd love for, as we talk about this, if the panelists can each kind of, what are the aspects of earning yield in this DeFi world that are good, that are bad, that are useful, that are useless? Break out any little parts of it, right? So I'd start by saying, has what we've seen in DeFi so far, is it really that different than non-DeFi lending?
Well, one aspect that I think is pretty different is the prevalence of over-collateralization in lending, right? And that's one of the reasons why Agio Ratings got its start. We recognize that no financial market grows without credit. There's a ceiling, right? And for credit to exist, you take some borrower risk, right? You can't over-collateralize everything. And while I think this has been like a genuinely cool thing to watch, the techniques and the systems to enable, these yield farming and other configurations of lending, we need to evolve from that system, right? And we probably need to figure out how to take some borrower risk. Where I see that going is, with RWAs, because now you're probably going to have to do a little bit of borrower underwriting. But then you're really, kind of glomming on, credit risk on top of like protocol risk and governance risk and everything like that. And those need to be decomposed and understood really well. And the decomposition has happened really well. There are a lot of people and firms that focus on it. The understanding has not been done to the level of rigor that I would hope to see, right, in the near term.
Jesse, you want to add that?
Yeah, I think one of the things you touched on in the very beginning is really interesting, which is over-collateralization as a very different thing. And I think that identity actually, or like kind of omni-chain identity, actually solves a lot of this, because right now it's 0x5J923, whatever it is. The only way that I can recoup is either via kind of insuring it or via having it over-collateralized, and essentially the smart contract calls it back. With some sort of kind of unified identity, you start to be able to tie this back and have like a reputation score and start looking at credit in that way. I think that's really interesting. I really don't think we have yet, or I think we have yet to see that. But I'm very interested in that part. And I do think that there is a place for both, though. I don't think that a lot of the tokenization, like wacky things, LPs, governance tokens, are going away. But the last thing is I do see big organizations like Uniswap, blue chips, right? Uniswap Aave going more kind of towards the client or app layer in terms of as close to the user as possible, right? Uniswap wallet battling through the Apple thing, because I think we've kind of exhausted a lot of the stuff that we can actually do with DeFi on the protocol layer, et cetera, infrastructure layer.
Gotcha. Back to stablecoins, I'm going to throw it out there.
Yes.
There's a lot of different types of stablecoins, different versions being that have been created, that are still to be created. What ends up if stablecoins are the core value or the core medium of DeFi? Are we going to see 10 different types of stablecoins out there? And when I say type, I do mean type. Is there going to be crypto backed? Is there going to be delta neutral? Or are a lot of these merely thought experiments that are expensive to the VCs who back them?
I mean, I think you might. I think you might see certain stables backed by other cryptos. You might see other cryptos backed by other cryptos. I don't know if there's really. I feel like you could do any of the above. You could back it to $1.
You can do any of the above, but if it gets too complex for that end user to understand,
yeah.
Does the market end up moving away from it?
I think the market would tell you because it would fail. I think people would want to make money, and they'll make money any way you provide that to them, whether it's the right way to do it or not. Actually, yeah.
I think one thing that, I don't know about the audience, but I've learned over the course of the last 5 years is that users will use anything that you put in front of them if you have a positive yield number. And that's part of the big reason why regulators are concerned, because consumer and investor protection is something that they see as a risk in DeFi. I will say I think that stablecoins are subject to the same forces of capitalism as everyone else, right? Every other industry. Tether is getting the lion's share of usage for a reason. It's just been, around a lot, very resilient. I've heard some really interesting use cases in a previous conference around the way that, oil producers in Africa and the Middle East are using Tether, to really get the payments going, because if they have to go through the fiat rails, it just takes too much time. So I think if there is a stable coin that is stable, focuses on one use case, right, and can deliver value, it will win.
Awesome. Guys, we are out of time, and so I'd love to offer to answer some questions, but we're not going to at the moment. So thank you all. We're all available to chit-chat with afterwards.